Welcome to our comprehensive XAUUSD market analysis for November 17th to 22nd, 2025. This week marked a critical juncture for gold as it tested the psychological $4,000 support level following 4 consecutive days of losses. We'll examine the dramatic shift in Federal Reserve expectations, analyze the mixed NFP data that shook markets, and explore what technical indicators are telling us about gold's next move. From fundamental drivers to expert opinions, trading strategies to price forecasts, this analysis provides everything you need to navigate the current gold market. Whether you're a short-term trader or long-term investor, understanding these dynamics is crucial for making informed decisions. Let's dive into the data and uncover what's really happening in the gold market. Gold faced significant headwinds this week, stumbling from $4,083 to test the critical $4,000 psychological support level over 4 consecutive losing sessions. The most dramatic development was the collapse in Federal Reserve rate cut expectations, plummeting from near certainty at 100% to just 39.8% probability. This shift followed the September NFP report, which delivered mixed signals. Job creation beat expectations, but unemployment climbed to 4.4%, the highest level since 2021. Technical analysts are raising red flags about volume divergence, a classic topping signal where recent rally attempts show significantly weaker volume compared to October's spike. Despite these near-term challenges, gold remains on track for an exceptional 50+% yearly gain in 2025, though it's currently trading 7% below October's all-time highs. Let's break down the week's price action. Monday, November 17th, saw gold drop $58 to $4,024.79, a 1.44% decline. Tuesday continued the slide with another 0.8% loss to $4,011. Wednesday brought some relief with a 1.2% bounce to around $4,060, followed by a modest 0.4% gain Thursday to $4,077. Friday saw range-bound trading between $4,065 and $4,076. The week's trading range spanned just $72, from $4,011 to $4,083, representing roughly 1% variation, remarkably low volatility for gold. Despite this week's weakness, gold's year-to-date performance remains stellar at 50 to 52% gains. However, the metal is now 7% below its October all-time high, raising questions about whether this is healthy consolidation or the beginning of a deeper correction. The technical picture presents concerning signals. Gold is consolidating within a triangle formation, building pressure for a significant breakout in either direction. The most worrying development is volume divergence. Recent rally attempts show dramatically lower volume than October's spike, a classic topping signal that often precedes reversals. The $4,000 level has emerged as the critical line in the sand. Hold it, and we likely see continued consolidation. Break it, and a deeper correction toward $3,900 becomes probable. The 50-day exponential moving average sits at $3,950, representing major support. Technical analysts warn that a break below this level could cause the market to fall apart. Key resistance levels stand at $4,200 and $4,400, while support zones are $4,000, $3,950, and $3,900. 5 fundamental factors are driving gold's current behavior. First, Federal Reserve policy has turned hawkish, with rate cut expectations collapsing from near 100% to just 39.8% following mixed NFP data and divided FOMC minutes. Second, USD strength is creating headwinds. The dollar rallied strongly against all major currencies, and with gold's negative 0.70 correlation to the dollar, this creates significant pressure. Third, paradoxically, the risk-off environment is negative for gold as markets entered a deleveraging phase rather than extreme fear mode. Fourth, the government shutdown's impact created data uncertainty, with delayed economic reports creating an information vacuum for Fed decision-making. Fifth, easing trade tensions, particularly the U.S.-Switzerland agreement, and improving global relations, reduced the geopolitical risk premium previously embedded in gold prices. Expert opinions are sharply divided. The TradingView community shows mixed sentiment. Bulls see this as a corrective phase before the next major push, while bears warn that breaking below $4,000 could trigger deeper downside. Investing Live's Justin Lowe remains cautious, stating he's not buying dips in this latest stretch, waiting instead for the market to shift from deleveraging to extreme fear. Action Forex focuses on policy risk, questioning how can the Fed make the right decision with no data, and positioning gold as a hedge against policy failure. Forex.com takes a neutral stance, noting the remarkably low 1% volatility over 4 sessions while gold tests waters around $4,000. Daily Forex's Christopher Lewis sounds the most bearish note, warning that volume divergence is a classic topping signal and that gold isn't the one-way bet it once was. For short-term traders looking at the next 1 to 2 weeks, expect a range between $3,900 and $4,150. We assign 30% probability to a bullish scenario where gold breaks above $4,125 and targets $4,200. The base case, with 40% probability, sees continued consolidation between $4,000 and $4,125. A bearish scenario, also 30% probability, involves breaking below $4,000 and targeting $3,900. The midterm outlook for 1 to 3 months spans $3,700 to $4,350. The bullish case, 35% probability, requires a 25 basis point Fed cut in December, potentially leading to a retest of the 4,381 all-time high. The base case, 40% probability, sees extended consolidation between $3,900 and $4,200. The bearish scenario, 25% probability, involves a hawkish Fed hold, potentially dropping gold to $3,700. The critical event is the December 10th FOMC decision. We present 4 strategies for different trader profiles. Conservative range traders should buy the 4,000 to 4,050 support zone, sell at 4,100 to 4,125 resistance, with stops below 4,000 and 2 to 3% position sizing, targeting 1.5 to 3% returns per trade. Aggressive breakout traders can go long above $4,150, targeting $4,250 to $4,400, or short below $4,000, targeting $3,900 to $3,800, with tight 1 to 2% stops. But wait for volume confirmation, as false breakouts are common. Patient dip buyers should layer entries, 25% at $4,000, 35% at $3,900, and 40% at $3,800, targeting $4,250 to $4,400 for 10 to 15% gains, with stops below $3,700. Long-term investors should use dollar cost averaging plus opportunistic dip, buying at $4,000, $3,900, and $3,800, targeting $4,500 to $5,000 over 6 to 12 months, based on Goldman Sachs' $4,900 target by end 2026. Recent events have shaped the current landscape. November 19th saw FOMC minutes released, revealing divided views among Fed officials on the pace of rate cuts. November 20th brought the critical September NFP report with mixed signals. Jobs beat expectations, but unemployment rose to 4.4%, the highest since 2021. The government shutdown ended between November 17th and 21st, restoring funding but creating delayed economic data that leaves a vacuum for Fed decisions. November 18th saw the U.S.-Switzerland trade deal, easing tensions and reducing gold's geopolitical premium. Looking ahead, December 10th brings the crucial FOMC decision, with markets now pricing just 39.8% probability of a cut. December 13th's CPI report will be critical for the Fed's path. Late November will see delayed economic data releases, and January 30th, 2026 marks the next government funding deadline. In conclusion, $4,000 represents the critical line in the sand for gold. This psychological support level will determine whether we see consolidation or deeper correction. The near-term outlook is characterized by elevated uncertainty with divided expert opinions. Range-bound trading is likely until the December 10th FOMC decision provides clarity. However, the long-term outlook remains constructive. The secular bull market in gold is intact, supported by central bank buying, geopolitical risks, and the ongoing monetary easing cycle. Goldman Sachs maintains their target of $4,900 by end 2026. The volume divergence warning cannot be ignored. Recent rallies lack the conviction seen in October's spike, yet fundamental support remains strong. The key takeaway: gold isn't a one-way bet anymore, but for patient, disciplined investors who understand the risks and manage positions carefully, the fundamentals remain supportive for long-term appreciation.